The S&P 500 is down over 7% in the last 3 sessions as the CPI numbers came in a lot hotter than expected last week, and this has caused some huge price breaks across a number of different key levels. The S&P 500 is making a new low for the year. Over the weekend, cryptocurrencies absolutely got hammered, and the U.S. dollar is strengthening once again, nearing a breakout. So we're going to take an in-depth look at those 3 things in today's video. First and foremost, I want to put back on our fib retrace levels from the 2020 low on the S&P 500. We talked about the importance of this 3,800 level because that was the 38.2 fib retrace level from this move. We held in May and made that nice bounce. We set up in a flag and we broke below. And now we are making new lows. If the bulls cannot hold this zone on a closing basis today, where can we fall to? It makes a lot of logical sense to test that 3,500 level, which is the 50% retrace, meaning it is half of the move up that we would have retraced back. And that's perfectly normal price action to see a market go 2 steps forward, 1 step back before making another move potentially up. The other reason why 3,500 is such an important level is that is actually where we broke out from at the end of 2020, right in this 3,500 to 3,600 zone. We spent a couple of months inside this range and made a nice, powerful break above, and that's where we went off to the races. So coming back down and testing that 3,500, 3,600 level makes a lot of sense from a price action standpoint. And the highs before the coronavirus would be the bottom end of that range, just above that 3,400 zone. So coming all the way down into this area right here makes a lot of sense. If the market loses that zone, that is a really bad sign, because typically when we see things break below that 50% retrace level, right, the last kind of supports that 3,200, but there's a high percentage of times where we actually retrace even more than that. So the market really wants to pay very close attention to the closing basis above 3,800 today on Monday, and if not, watching that 3,500 level. And when we remove this from the screen and we back the chart up even further so that you guys can see it like a 10-year look at things, right, we have some major levels of support from the breakout the beginning of 2020 around that 2,900 level, and then there's massive long-term support still at that 2,200 level. We're way above these zones for right now, and I think the key really to pay attention to is this zone right here as we've just laid out. What happens in this area is going to be very, very important if we can't hold that 3,800 level. Let's look across the other indexes as well and see what's going on here. The Nasdaq, low of the year as well here. The key level for the Nasdaq from a breakout standpoint in 2020 was back up here at 12,500. We are well below that. The bottom end of that range is about that 10,700 zone. If we throw that fib retrace up on the screen for you guys here on the Nasdaq, we've actually retraced the 50%. And as I just said, when we took a look at the S&P 500, breaking below 50% oftentimes means more pain is ahead. That key 61.8 in the last vestige of support off of the fib retrace levels right around that 10,500, and that certainly could be on deck if we don't close above the lows of the year today on Monday. We jump in now, we'll take a look in at the Dow. The Dow has been stronger on a percentage basis this year as people have spent a lot more time putting capital towards companies that are paying dividend, giving a return on capital. And so the Dow really has a much stronger barometer in that area of the market. And you can see we haven't made the new low yet, right? So we have not taken out May's lows, and this is one sign that the bulls do like. Putting in that higher low here, if this area holds, is a very good thing for this area of the market, and maybe the market as a whole. If we lose that zone, that 29,000 level makes a lot of sense because that's when we had the price breakout in 2020. If we throw our fib retraces up here on the screen, right, we haven't even had that 38.2 fib retrace level yet, and so a move just under 30,000 in that 29,000 zone would fall right back into this major area of support, and that would be a logical spot where we could see some price hold if we do break below the low of the year. Below that, the middle of the zone is really the breakout from 2019 on the Dow, and it's 27,000, and that's the next level to watch there. Now, the Russell is also putting in, and you guys can clearly see that, a potential higher low here. right? The Russell needs to lose just underneath of that 1700 level for that market to make a new low of the year. The risk-on area of the market, so the fact that it's not making a new low is a good sign. It is back-tested, though, the actual breakout from 2020. So, again, much weaker than all of the rest of the indexes. And let's put those fib retrace levels on here so you can see just how much weaker it is. We come in here. We got that bounce right off of that 50 level. That's where we made that first bounce. Again, if we lose just underneath 17, our next zone is really that 1500 level. And if we get back to 1500, that's the same price that we were trading at in 2017. All right. If I put the Russell Index up, you can see a further price all the way back here to 2013. But if we fall back down to that 1500 level, we're back again half a decade lows that could be being put in here. So we really need to pay very close attention to what goes on in the Russell because it is such a good gauge of the overall risk-taking behavior of the market. So big level here. Let's take a look now at the U.S. dollar. The U.S. dollar, and I'm going to back this out on a monthly chart to begin with, right? We're sitting at a level that we haven't. If we basically just make about a 0.5% move, we make new highs. And the last time that we traded at this price level was back in 2002. So these are 20-year highs that we have out of the U.S. dollar. We have a long-term sideways range, right? A legitimate breakout above this is a huge, powerful chart pattern, okay? Because the last time we sat in a range like that for such a prolonged period of time, right, when we made that breakout at 86, we ran all the way to 104 in the course of 2 years. It was an extreme strengthening of the U.S. dollar. And on a percentage basis for the U.S. dollar, that's huge. This is a 20% move. We're just starting to leave this zone right now. And if we get a legitimate breakout once again, the size of this range right here is about 15 points, right? If we drag that over to the breakout spot, that puts us right up near those highs that we saw back in 2002, right around that 118, 120 mark. That would be a huge headwind for the overall market. Fed rate decision comes out this week. It's going to have a huge impact here on the U.S. dollar. But if you make that break over 105 and it holds over 105, that's a very, very strong chart. And that, again, is a very, very tough headwind for the overall market. Bonds here breaking down. We now have another lower low put in, meaning rates looking like they want to continue to rise, which makes a lot of sense considering the inflation came in too hot. Markets looking at the Fed this week to see what they're going to do. We might get a quicker hike than was expected. Bonds have been selling off sharply on that news. And when we look at this, I'll back this out in a monthly chart here as well. We're back down to 2013 zones if we fall below this level. And below this area, right, that next area of support really comes all the way back into the lows of 2011 and the breakout spot from 2007, 2008. Meaning if we continue to push down here, we can undo the majority. And again, this price point right here is trading in 2003. We could give up 20 years worth of gains in the 30-year Treasury market, which is a huge move and a major impact to the overall market. Now, last but not least, I want to take a look in at those cryptocurrencies. Let's look in at Bitcoin. Bitcoin broke below the low of 2021. Cleanly trading now at 23,000. The major price breakout level happened back at 13. And so it would not be surprising to see crypto continue to fall, Bitcoin continue to fall back towards that 13,000 breakout level. It's not what the bulls want to see in any way, shape, or form, but we clearly now have not held this zone. Underneath the 28,000 is where bad things can happen, and we're down almost 20% over the weekend here. And it looks even worse in Ethereum, which is down almost 30%, sitting at around 27% right now. It has undone all of 2021's gains as well. And this break underneath of 1,600 is really bad for this space. So cryptocurrencies are not acting as that hedge towards inflation and is acting more like tech and has for the majority of this year and has been trading kind of lock and step with the Nasdaq as that pain continues to be in the growth and tech area of the market. We've seen that pain also transfer over into the crypto space as well. A lot of key levels in play here this week. the Fed speaking on Wednesday is going to have a huge impact. Markets under extreme pressure, making new lows of the year, but there is a slight vestige of hope with the Russell not making a new low and the Dow not making a new low, and the dollar quite hasn't ticked to a new high. We're going to pay very close attention to this, and we'll keep you apprised throughout the course of the week. Stay safe out there, guys. Take care.